Hello, everyone. So we are looking at chapter 4, which is cost, volume, profit. So in this chapter, our learning objectives are to explain the concepts of contribution margin, break-even point, and CVP graph. We will be looking to identify the key assumptions of CVP analysis. We will describe the use of CVP analysis, calculate break-even point, calculate sales required to achieve targeted profit, define and compute margin of safety, and calculate operating leverage. So starting with our contribution margin and break even. So your contribution margin is your sales minus your total variable cost. Now this is something that we have seen in our contribution format income statement as well that was discussed in chapter 3. So that's what your contribution margin is. It's equals to your sales minus your total variable cost. Now, if we want to look at our contribution margin on a unit basis, then we can take our total contribution margin and divide that by total units. Our contribution margin ratio is your total contribution margin in dollar divided by total sales. Alternatively, we can also calculate this by taking contribution margin per unit and divide that by the selling price. Either way, we should be able to calculate our contribution margin ratio. So your operating income or your profit is your total contribution minus your fixed cost. And at your break-even point, your profit is 0. So break-even point is where the company is not making any profit, but neither are they losing any money. So once the break-even point is hit, then any sales after that point will increase the operating income for the business. So at your break-even point, your profit is equal to 0 where the company is able to only recover their cost. So your total contribution margin is exactly the same as your fixed cost, because generally if you think of your contribution format income statement layout, we have our sales minus our total variable cost that gives you your total contribution margin. Out of that comes your fixed cost. So in this case, at the point of break even, your total contribution margin is the same as your total fixed cost that gives you a 0 at the bottom line. So with our cost volume profit graph. So your cost volume profit analysis will help the managers understand the relationship amongst the cost, volume, and profit. So the CVP focuses on how the profits are affected by 5 factors basically. One is the price of your product. So the managers will determine which price to charge, how much should they charge for the product. If you think of your cost actually has 2 elements. There is a variable cost and a fixed cost. So the discussion around that is how to manage your cost. Should you have high variable cost, or should you have high fixed cost, or should you have a mix of both of those? How would the volume affect your bottom line? So the volume of production, do we have enough resources for that? Do we have capacity? Do we have manpowers? Are there bottlenecks? Those are the considerations. And finally, the fifth piece to that consideration is your product mix. So if the company is selling multiple products together, then how is that product mix affecting their cost, volume, profit? So here we have to keep in mind that we are trying to understand the relationship between revenue, cost, profit, and volume so that we can understand how the bottom line will be affected by these changes before we actually make the changes. Okay, that's why understanding the cost, volume, profit analysis and the relationship amongst these factors becomes incredibly important. Okay, once the company hits their break-even point, and as we said in the earlier slide, your break-even point is where the company is not making any money, but they're not losing any money either. So they are breaking even, they just have enough sales to recover their fixed and variable cost. Any sales past your break-even point will give you positive operating income. So some of the assumptions that the CVP analysis is based on is that your selling price will always be constant. Your costs are linear and they can be divided into variable and fixed components. If we have multiple product mix, then the sales mix will remain the constant. Okay, so if you're selling two pans together, a bigger size and a smaller size, then your product mix will remain the same. If you're selling two different types or two different flavors of chips together as a unit, then that will remain constant. So we will not change that product mix because that can have impact on sales. For manufacturing companies, we are going to assume that the number of units produced are the same as number of units that are sold. So all of our CVP analysis is based on these assumptions for what we are learning. So why use the CVP analysis to begin with? So CVP analysis, or the cost volume profit analysis, can help in incremental analysis. That is an approach that focuses on those items of revenue, cost, and volumes that will change as a result of decision. So the whole idea is to understand these variables and effect of any change on the bottom line before those decisions are made to make the changes. So some of the examples of CVP analysis that will help in predicting the effect are the changes in the fixed cost and the sales volume, changes in variable cost and sales volume, changes in fixed cost, selling price and sales volume, changes in variable cost, fixed cost, and sales volume, and the changes in selling price. So any of these changes will impact your bottom line. So generally speaking, then your decision rule is we will only go ahead and apply the change if the increase in your contribution margin is higher than the increase in the fixed cost. Okay, that means the benefit is higher in this case. So if the increase in the contribution margin resulting from the change is higher than increase in the fixed cost, then we would implement it, otherwise no. Alternatively, if your decrease in the contribution margin is lower than the decrease in, or your decrease in the fixed cost is higher than the decrease in the contribution margin, then that's a good decision as well. So in order for us to calculate our break-even point, so a point where the company is not making money, but they're not losing either, they have enough sales to cover their cost. So at break-even point, your total sales will be enough to cover your variable expenses and all of your fixed expenses. So if we are calculating our break-even point in the units, then we take our fixed expenses and divide that by our contribution margin per unit. If we intend to calculate our break-even point in sales dollar, then we can take the same fixed expenses, but divide that by the contribution margin ratio. So looking at an example here, example E4-5. So Moro Products distributes a single product, a scarf. Its selling price is $15 and its variable cost is $12 per unit. The company's monthly fixed expense is $4,200. So we are solving for the company's break-even point in unit sales. So for that, we will be looking at the contribution margin per unit. So if we are selling something for $15 and the variable cost of that unit is $12, then on per unit level, our contribution margin is the difference, which is $3 here. So our break-even point in number of units here will be our fixed cost of $4,200. Divide that by $3, which is your contribution margin per unit. We will have to sell 1,400 scarves in order to cover all of our fixed cost. Number two, solve for the company's break-even point in sales dollars. So in order for us to calculate that, we are going to look at break-even point in sales dollar. So if we are selling 1,400 units, that is our break-even point, and selling price for each scarf is $15, then our break even in sales dollar is $21,000. Number 3, if Morrow Products decide to drop its selling price to $14 with no change to variable cost per unit or fixed expenses, what will be the new break-even point in unit sales? Now here the selling price is changing. So if your selling price drops, then your contribution margin is also going to change. So our new selling price is $14. Our variable cost per unit hasn't changed. That is still $12. But the new contribution margin per unit is now only $2. So because we have our contribution margin that is lower, we will have to sell higher number of units to cover our fixed cost. So your break-even point in units here will be the fixed cost of $4,200. Divide that by $2 per unit. So in this case, we will have to sell 2,100 scarves. So if we look at the break-even points in sales dollar, then 2,100 scarf at break-even point multiplied with $14 of selling price, we will need to have total sales of $29,400 in order to cover all of our fixed cost. Okay, so at break-even point, our margin is our net is going to be zero. There will be enough sales to just cover all of the variable cost as well as the fixed cost. Looking at our targeted operating income, your sales is your variable expenses plus your fixed expenses plus your targeted operating income. Your targeted operating income is what is the company targeting? What do they want their bottom line to be? So in order for us to achieve that bottom line, what is the level of sales that we need to achieve? That is the whole premise of this calculation with targeted operating income. So our total sales in that case would have to be enough to cover for all of our variable cost, cover for all of the fixed cost, as well as the target operating income that we intend to achieve. So your unit sales to achieve the target operating income, so if you are looking at the total number of units to sell, in order to achieve a targeted operating income, then we need to take our fixed expenses, add our targeted operating income, and that total will be divided by your contribution margin per unit. If we want to look at the same analysis in dollar sales to achieve, then we will still take, your numerator is not changing. So we would still take our fixed cost or your fixed expenses plus our targeted operating income, but we are dividing that by the contribution margin ratio. That will give us the total dollar of sales to achieve in order to have the target operating income. Now your targeted net income. So your net income is after tax profit. So for example, if your tax rate is 40%, then your operating profit of $100 will result in net income of only $60. So with regards to your relationship, our net income equals your operating profit minus your taxes. If we simplify this, then we are looking at our operating profit minus your taxes, which basically is your operating profit times your tax rate. We can also look at that as your operating profit multiplied with 1 minus the tax rate. So if we are looking to achieve the unit sales or calculate the unit sales to achieve our targeted net income, then we will first calculate our targeted net income, that is divided by 1 minus the tax rate, then add on our fixed expenses and divide the total by contribution margin per unit. If we intend to calculate the dollar sales to achieve for targeted net income, then we will take the same numerator but divide that by contribution margin ratio. So the alternative approach to that without any formulas is your total contribution margin has your fixed cost. In that, we will add your targeted operating income. So fixed cost plus your targeted operating income is what our total contribution margin is that we need to target. The only thing to keep in mind here is that your targeted net income is divided by 1 minus the tax rate to calculate our targeted operating income before taxes. So once we have calculated our total contribution margin, then for the units required, we will take our total contribution margin that is calculated and divide that by the contribution margin per unit. So looking at example E4-6 here, so Nye Corporation produces and sells only one product. Its selling price is $100 and its variable cost is $80 per unit. The company's monthly fixed expenses is $20,000. So under required 1, we are solving for the unit sales that are required to earn a target profit before taxes of $3,000. Okay, so the target profit of $3,000 is before taxes, which means we don't need to convert anything. So we need to recover our fixed cost, which is $20,000, but we also need to have our targeted operating income of $3,000. So if we add these two together, then our contribution margin has to be $23,000. That's your total contribution margin. So if we take our total contribution margin and divide that by your contribution margin per unit, which in this case is $20, and that $20 is the selling price of $100 minus our variable cost of $80. So your contribution margin per unit is $20. So your total contribution margin of $23,000 is divided by $20. That gives us 1,150 units to be sold in order for the company to achieve the targeted profit of $3,000 before taxes. Now with the same example, we are solving for the dollar sales that are required to earn a targeted profit before tax of $4,000. Our fixed cost hasn't changed. Our fixed cost is still $20,000, but now we are targeting an operating income of $4,000. So our contribution margin total has to be 20,000 plus 4,000, which gives us 24,000. If we divide that by our contribution margin per unit, which hasn't changed, so selling price minus the variable cost of $80 gives you contribution margin per unit of $20. So total contribution margin divided by contribution margin per unit gives us 1,200 units that we need to sell in order for this business to have the targeted operating income of $4,000. If we want to convert this in the sales dollar amount, then all we do is take the the 1,200 units multiplied with $100 of selling price. So our sales have to be $120,000 in order to be ending with the target profit of $4,000 in this case. So with the same example, now we are calculating the number of units that needs to be sold to earn an after-tax income of $6,000, assuming the tax rate of 25%. Now, in this case, the $6,000 is after tax, and we have the tax rate of 25%. So if we want to simplify this, your operating income before tax, if we consider that to be 100%, then your tax rate in this case is 25%, which means our net income that is always after tax is only 75%. So 1 minus the tax rate. All right. So in order for us to calculate that, 75% of our operating income, which is $6,000, divided by 75% or 0.75 will give us $8,000. So your operating income before tax works out to be $8,000. All right. Once we have that, then we can carry on with our calculation. All we have done here is converted our net income to operating income. So from after tax to before tax. So we need to make sure that $8,000 of operating income is achieved in order for us to cover our taxes. So our fixed cost here hasn't changed. That is still $20,000, but our operating income that we are targeting is $8,000. So 20,000 plus 8 gives us total contribution margin of $28,000. And if we divide that by our contribution margin per unit, which is still $20, then we need to sell 1,400 units in order to achieve after tax or the net income of $6,000. Okay, so the next thing we are looking at is your margin of safety. Margin of safety refers to your excess of budgeted or actual sales over the break-even sales or volume. It is the amount by which the sales will need to fall from the current situation before the company hits the break-even point. So any further decline in sales will mean losses. This can be expressed either in sales dollar or as percent of sales. So your margin of safety is your total budgeted or actual sales minus our break-even sales. If we want to look at margin of safety in percent of sales, then we will take our margin of safety in dollars and divide that by total budgeted or actual sales. So margin of safety is pretty much like a safety net. Looking at example E4-6 that's adapted. So we were still looking at Nye Corporation produces and sells only one product. Selling price is still $100 and the variable cost is still $80 per unit. The fixed expenses haven't changed from $20,000. What is Nye Corporation's margin of safety if it sold 1,800 units last month? So what is the safety net that they have? So your fixed cost is still $20,000. In this case, our targeted operating income is a 0. So our total contribution margin is the same as our fixed cost, which is $20,000. So if we take our total contribution margin of $20,000, divide that by our contribution margin per unit, which is $20, selling price minus your variable cost, then our break even in this instant is 1,000 units. So if Nye Corporation sold 1,000 scarves, then they will be at a break even where they are not making money, but they're not losing money either. But we also know that their current sales is at 1,800 units. So we are calculating our margin of safety. So our margin of safety is the current sales minus your break-even sales. So currently we are selling 1,800 scarves and our break-even is 1,000 scarves. So that means the company's safety net is 800 units. If they lose sales over 800 units, then they will start incurring losses. So if we want to look at our margin of safety in sales dollars, then 800 units multiplied with $100 of selling price. So our safety net in dollar amount is $80,000. Expressing the same margin of safety in percent of sales, 800 units divided by 1,800 units. Okay, so your safety net or your margin of safety was 800 units. That divided by your current or budgeted sales of 1800 units gives you margin of safety as percent. In this case, it is 44%. Okay, higher your margin of safety, bigger is the safety net. The last thing we are looking at here is our operating leverage. So your operating leverage acts as a multiplier. So this is your operating leverage is the measure of the sensitivity of operating income to a given percent change in sales. So in other words, it can help predict for a given sales level how a change in the sales volume will affect the profit. So if we want to look at our degree of operating leverage, then we will take our total contribution margin and divide that by our operating income. Our degree of operating leverage multiplied with your percent of change in sales will give you percent of change in operating income. Looking at E4-8, so Enberg Company installs lawn sod in home yards. The company's most recent monthly contribution format income statement appears below. So we have sales, variable expenses, contribution margin, fixed expenses, and operating income that is stated. So we are to compute the company's degree of operating leverage. So we will look at that first. So our degree of operating leverage is contribution margin of $48,000 divided by our operating income of $10,000 gives us a multiplier of 4.8. So your degree of leverage or operating leverage is your multiplier. Now under 2, using the degree of operating leverage, estimate the impact on operating income of a 5% increase in sales. So how much would your operating income change by if we have 5% increase in sales? So if our sales go up by 5%, our operating income will change by 5% multiplied with our DOL, which was our multiplier degree of leverage of 4.8. So the total change will be 24%. So your operating income will go up by 24%. The same idea can be applied if you are reducing your, there is a decrease in the sales. Okay, so think of these things conceptually. So once again, the whole idea of this chapter is to understand various concepts with your cost, volume, profit analysis. Some of the ideas or some of the calculations we used for in this context is your break-even point, targeted operating income, margin of safety, and operating leverages. The managers want to understand the effect of these changes, change in the cost price, volume, you know, how many units do I need to sell in order to achieve a targeted profit? They want to understand all of that before making the change so that they can make the change accordingly to decide if it is beneficial or not. So all of these analysis is done in advance. So some of the examples that we will be discussing in class are the ones on the screen here. So that, my friends, is all I had for chapter 4. Thank you for listening.